How do I see this Powell and Trump fight going? Well, you first got to understand who's right in this situation. Like, is it Powell standing his ground saying we're not cutting rates? Is it Trump saying you guys are late, you need to be already cutting rates, right? Well, you need to look at some tells. The CPI is one of the most important things you can look at, right? Now, what CPI is going to show us is basically the percentage of inflation or deflation on a yearly basis, on a year-over-year basis, right? And basically what we notice is, back in 21 into 2022, inflation, and even into early 2023, inflation was completely out of control, right? You look back to even September 2021, you were looking at CPI of 5% plus. We hadn't seen numbers like that in decades. Like, that's insane. October, 6.2%. There was a clear trend that inflation was out of control. The Fed should have started raising rates basically in the fourth quarter of 2021 and then kept raising in the beginning of 2022. But they didn't do that. They started raising rates in like the second quarter of 2022, way late. And they paid the price for that. The consumer got hit much harder than the consumer should have gotten hit by inflation, essentially, right? Now, then finally, inflation started to get under control. It started to cool, right? But now inflation's been dead for 11 straight quarters. 11 straight quarters, right? 11 straight quarters. Now, the Fed is supposed to be data dependent. So if they're really data dependent and you look at CPI, are we in a situation where we have an inflation problem? The answer is absolutely not. There's 0% evidence that we have some sort of out of control inflation problem or even small inflation problem. There's no inflation problem. When you're in the twos for CPI, that's normal. You should always have some sort of inflation in the market. 2%, perfectly normal. So this is not 2021, this is not 2022. This isn't even like close to any of that. We have no inflation problem. Now, if you want to take it a step further, look where the Fed funds rate right now is. Fed funds rate 4.33%. CPI is right here. Now, if basically the Fed funds rate is significantly above where CPI is, that means the Federal Reserve is extremely restrictive. And that's what we're seeing right now. CPI is down here, and you got a Fed funds rate up here. It doesn't take a rocket scientist to realize the Fed is way restrictive right now. Way restrictive. Now, it's okay to be a restrictive right after you go through a major inflation spell because you're trying to make sure that doesn't come back. The inflation spell is several years removed now at this point in time. We haven't had an inflation problem since 2023. We're halfway through 2025 now at this point in time, right? No, if you look back here, the Fed had Fed funds rate on the floor. Meanwhile, you had CPI that was way up here. That was the Fed being way too lackadaisical, way too asleep at the wheel, and they should have been already raising interest rates significantly by this point in time, but they didn't do it, right? They made a huge mistake, and everybody paid the price for that, right? And obviously what happened in 2022 with the stock market and everything, like that was the price to pay, and a lot of places around the world got hit even much harder. So the moral of the story is here, yeah, we're way restrictive. The Fed should not be this restrictive. Now, if you want to take a step further, look at PPI. The latest PPI numbers came in at 2.38%. Dude, when inflation was problematic, we were talking about 11% plus PPI numbers. We're at 2.38%, the latest numbers. There's no inflation problem at all. So, when we look at this picture here, these two gentlemen, one of these men is right, and one man is wrong. And there's a lot of things that I don't agree with Trump on, that I think he plays it wrong, or, I don't like his perspective on. It's a lot of things. This is not one of them. I 100% agree with Trump. 100%, not a doubt in my mind. The Fed should be lowering right now. The fact that they are not makes no sense. PPI is not a problem. CPI is not a problem. Inflation is not a problem. The Federal Reserve should be lowering rates. Right now, they're far too restrictive. Far too restrictive. And Powell and the Fed have to wake up. They have to wake up. Now, there's a few more Fed meetings this year, essentially. Here's how I think this is going to play out. I believe the Federal Reserve will do 3 50 basis point cuts before the end of the year. So basically, they'll bring down the Fed funds rate by 1.5% before the end of the year. Now, if they don't do that, and we end up going into recession, they will take 100% of the blame. 100%. And even all the Trump tariffs and all that drama, at the end of the day, there's clear evidence, clear data. It's not even up for dispute or debate that we are far too restrictive for far too long, and the Fed should be lowering rates right now. There's no debate, right? And so if the Fed continues to keep these Fed funds rates up here with CPI where it's at, right? That's crazy. That's absolutely crazy. You look back at the past 20 years, 15 years, there's no time period where the Fed's ever been this restrictive. This is ridiculous. And so they've got to get lowering. So what we should be looking at is going into 2026, we should have a Fed funds rate somewhere between 2.75 and 3. Now, also, I believe if the stock market was much lower than where it is right now, I believe the Fed would have already been lowering. But because the stock market's holding up pretty well, the Fed seems like there's no rush. If the Fed's making their decisions based upon what the stock market's doing, they're lost. They're lost, man. They've got to get moving here. And, otherwise it's just going to be a horrible reputation for Powell. Like, Powell's already known as the guy that let inflation get out of control because he stayed, with a Fed funds rate on the floor when inflation was already out of control and we're at the highest numbers we'd seen in decades, right? Now he's going to play this game. It's going to end badly. He's got to get lowering. Got to get lowering. If he gets lowering, then we're looking pretty decent here. Okay. No. The second thing is we got some shocking data. Shocking data. Right. This is the latest AI investor sentiment numbers that came out. Right. I need to cover this because this is crazy. The market just went even more bearish. More bearish. So we had finally started a trend of basically the market getting less and less bearish. Nope. This past week just went more bearish. Went from 36.7% of investors feeling bearish on the market in the next 6 months to now it's almost 42%. The normal percent is 31%, folks. 31%. Now the historical average for bullishness is 37.5. These latest numbers came in at 32.9. So people are not feeling very bullish on the market the next 6 months, and they're feeling very bearish on the market the next 6 months, right? Crazy. That's wild, man. Wild. You think about how well the market's doing. You think about how strong earnings came in it. I mean, earnings look very, very good, especially for all the stocks that matter the most to the stock market. Like, the far majority of them look great. Good conference calls. And yet, just investors are bearish, man. Just remaining bearish. No. If you guys follow me on the reaction channel, I'm not sure how many of you guys follow me on the reaction channel. It's called Jeremy Lefebvre Makes Money, right? Yesterday, I reacted to 3 Tom Lee clips, right? In one of those Tom Lee clips, he was talking about how hated of a bull market this is. And there's no doubt, this is an ultra-hated bull market because you have the market just blasting higher. It's up 20, NASDAQ's up 27% from the lows. You're seeing stocks up 40, 60, 80, 100+% in the last 2 months, right? Meanwhile, people are saying, we don't have a conclusion on all this tariff stuff. We don't know how all this is going to work out. Recession fears, inflation fears, blah, 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 right? We don't know what the Fed's going to do. And so, but the market's just rallying. That's called a hated bull market. But I can tell you guys, since I've been in the market, right, which I got in the market 08, 09, many of the most hated markets we've ever seen were some of the most bullish markets you've ever been in, with just gains that were ridiculous. This 09 market, when we bottomed early 09, that was a hated market. Hated. That market just rallied like insane in 2009 and into 2010. Meanwhile, people, investors are looking out there and like, how are people buying stocks right now? Look at how bad the economy is. Look at the unemployment rate. Obama's a socialist. Blah, blah, blah. Right? They gave a million reasons why you shouldn't be buying stocks. And at the end of the day, the market just soared. And it was an ultra-hated bull market. If I show you the 2020, oh my gosh, coming out of that 2020 crash, that was a hated bull market. People are like, why is the market rallying? Like, we still don't know how all this Rona stuff's going to work out. We don't know how any of this is going to go. Like, blah, blah, blah. That was a very hated bull market initially coming out of Rona, right? Even what happened in 2022, and as that market started to rally at the end of 22 and going into 23, oh my gosh, Wall Streeters were still so bearish. If I show you, I still have them on my computer, I have screenshots of what the S&P 500 price targets were for the end of 2023. Oh my gosh, they were so bearish. They were so bearish. And I think I have the 2024 ones as well. They were insanely bearish. They thought like a lot of these Wall Street firms basically didn't even have the market going up. Well, guess what? The market rallied like 20% and then another 20%. Like, it's just ridiculous, right? What a hated bull market that was. Many of the most powerful bull markets you will ever be in, it's not people all cheering happy. It's people miserable saying, how is this market going higher right now? It shouldn't be going higher. It should be stagnant. It should be going down, right? Why am I not more invested? That's actually the most powerful bull markets. The very, I call it lame bull markets, are actually when everybody's rooting for the market to go higher. When all the hedge funds are really fully invested, when all the retail's fully invested. That's actually the lame bull markets. And that's actually when you get ready for a flip there, okay? Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with. Okay, let's pull up Tom Lee's latest comments here.
For a melt-up rally, that is what our next guest is calling for in the months ahead. He is Tom Lee. He is FundStrat's co-founder and the head of research, also a CNBC contributor. And as you see, he's here at Post 9. Nice to have you.
Great to see you.
Just saw Dietrich on. He's bullish. And you are too, but you say too many people are not.
Yeah, I would. You'd think that with the S&P doing well this week and a great May, investors are bullish. They are not. In our calls and Zooms with portfolio.
Listen, I got to explain this, okay? Because Tom Lee was talking about hated markets, right? And 100%, it doesn't feel like we're in some super bullish time, even though you look at the market and it looks insanely bullish. And it's because still so many hedge funds, still so many investors are cautious, kind of not feeling great, right? Once again, that could change if this market hits new all-time highs and then starts busting through all-time high after all-time high. Things will change quickly. But remember this. Many of the most insane rallies you'll see in the stock market are hated rallies. Meaning, a lot of people were offsides, they were not nearly as invested as they wanted to be, and the market just rips. And people are mad. They're disappointed. They're sad because they're like, we got bad news, bad news, bad news, bad news. I'm not invested the way I want to be invested, and the market just keeps going higher. So it's a hated market. And then is exactly what we've had over this past month and a half to 2 months. No, for the people that were buying the dip heavy in March, and especially in those first few weeks of April, right? You're happy as can be, right? People like myself, people like a lot of you guys watching this, we're like, this is awesome, man. But we're a very small minority. You gotta understand, so many of these hedge fund managers were selling. While we were buying, they were selling. And now many of these stocks are up 30%, 40%, 50%, 60%, 70, 80, 90. Some have even over doubled from the April lows. And so people are looking and they're like, are you kidding me? There's still so much bad news. There's still so much drama, tariffs. We don't have, conclusive evidence of which way things are going, blah, blah, blah. And so it leads to people hating a bull market like this, right? But you got to understand, when things look great again, there's not going to be as much money to be made. That's the thing you got to understand about the stock market. When everything looks great, you can make money, but that's not when the most money's made. The most money's made buying when things look bad, scary, I don't want to own it. That's when you make the real big bucks. A situation like what has happened the past few months, or a situation like what happened after Rona, right? I mean, gosh, we were still getting so much bad news. We still don't know how Rona was going to shake out, but gosh, if you were buying stocks in March of 2020, April of 2020, you made fortunes of money coming out of that. But it was a scary time. Same thing if you were buying stocks in March of 2009, You got the most attractive pricing in generations of investors, right? But guess what? That market was extremely hated. People still said, look at how many people are losing jobs. Look at how bad the economy is. Look at this. And you guys are out there buying stocks in, the market's racing higher and higher and higher. How are you doing this? The market looks forward. And so the market is looking forward. It's saying things are going to get better and better from here for this next bit of time. And so things continue to get bought up, right? And it's hated. They hate it. Unless you've been buying heavy, you don't hate it.
Managers, many are still cautious because they see tariff risks ahead, and they don't have tariff resolution in hand, and they can't get bullish. I think the feedback we get from a lot of folks is they think stocks shouldn't be rising. So I would say, given the amount of cash on the sidelines, the fact that short interest is going up, and we have a quiet week and markets are rallying, I think the risk is now of a substantial leg up rally from here.
What role do tariffs play in all of the way you're thinking about the market?
Well, it's the thing. What do? You're one of these fund managers. You're 90% plus cash. You're watching the market just go higher and higher. What do? Do you stay cash while the market just continues to rally in your face and the news gets better? Do you start shorting and risk losing all your fund if this market continues to rally higher and higher? Or do you buy and say, you know what, I missed a lot of this upside? You got to understand, a lot of these Wall Streeters have the perspective. It's a horrible perspective to have, by the way. Don't ever have this perspective. But a lot of these Wall Streeters, and I've heard of, I've watched CNBC and hear these Wall Streeters come on, they're in Bloomberg all the time for 16 years now. A lot of these Wall Streeters have the perspective of, I'd rather miss the first few weeks or the first few months of gains, but I was in more downside. Horrible strategy. Absolute trash strategy. The best strategy to have is like the strategy I have, where you see a major correction going on in the market or a major crash, and you're just buying. You understand you can't get everything at the bottom, and that's fine. Because that rally coming out over the next few months, few weeks, it's dramatic. It's not like the market moves up a little bit. No. We just spoke about it. A lot of these stocks are up 30% to 100% plus from where their lows were back in April. So you're a fund manager, you've been waiting. Now you're going to buy a stock at a double X premium. I mean, it's just crazy. But a lot of them think like that. It's a flawed thought process. It's one of the most flawed thought processes I've seen in the market. But a lot of them think like that. And so, you just got to understand, a lot of them won't mind buying. If this market hits all-time highs in the next few weeks here, right? A lot of these fund managers will not mind buying, even though the market's already blasted all-time highs, even if they're way underweight, because they have the perspective, a flawed thought process of, well, at least I saved myself from more potential downside that could have came, and it didn't come, right? So a lot of them have no shame. They'll gladly buy the market at all-time highs if it hits all-time highs in 2 weeks from now. They'll gladly buy, an S&P 500 at 6,400, 6,500, 6,600. They have no shame. They'll gladly buy that. It's crazy, man. Crazy.
Tariffs matter. Remember, before February, before Trump sort of talked about this, the base case for many was a 15% tariff. Mm-hmm. Let's say that we're going to end up at a 10%. That's 10% on 15%, which is imports, which is about a 1% GDP effect. That's not that different than oil going from 40 to 80, and we wouldn't say $80 oil breaks the economy anymore. So I think tariffs we have to adjust to it, but it's not the thing that takes us to 4,000 S&P anymore.
Now, what if there's a renewed and more protracted, if not dug-in fight over the tax bill? What if Musk's post on social media earlier is enough to get some lawmakers in a very thin margin Washington to rethink their positions based on his political donations or lack of support in the future? Is that a real concern in any way?
Well, this is what's going to be set up as what I'd call event risk. And it's event risk similar to a government shutdown or an auto plant shutdown, something that affects the economy for a specific period of time. But again, those have not been things to turn structurally bearish. They may be tactical risks, but again, they've always been buy the dip opportunities.
So if for argument's sake, the tax bill ends up not as big as the price tag is on it now, would that be a positive taken by the market? Maybe the bond market would feel pretty good about that, wouldn't it?
Yeah, I mean, Scott, it's kind of hard to say because I could see it being if bonds rally, that's good for equities. But if this tax bill leads to more spending...
I got to be honest with you. These politicians don't care about Musk. They don't care about him at all. You think they're going to magically change because Elon Musk tweeted whatever? No, they don't care about him. They used him for what they had to use him for, which was basically just, somebody that has a very big brand and a lot of people that love Elon Musk, right? To peddle his right-wing propaganda, right? There's left-wing propaganda that people peddle. There's right-wing propaganda that people peddle, right? Now, if you're on that side, you say it's not propaganda, this is the truth, this is all good. Red cult, blue cult, blah, blah, blah. But at the end of the day, they used him what they needed to use him. They don't care about what he says. What Elon Musk says is irrelevant to them. And I think he's now learning about power for real. Kind of like the scene in, Dark Knight Rises, when Bane goes to the rich guy, do you feel powerful now, or something like that, right? It's kind of the situation that's going on here now, where, they don't care about what he tweets or what he says. They're going to do whatever they want to do. And if Elon Musk isn't going to donate money to them, that's fine. There's a trillion other people that are ready to donate happily to them. He's just one guy, one dude out there. Does he have a big pocketbook? Sure. But I can tell you, he doesn't even donate the most money, even close to the most money, out of a lot of these folks. Like there's whole levels to how much some of these corporations, how much these high net worth individuals will donate to left wing and right wing different folks. And some will go directly, some go through these. I don't even want to get into it, but the moral of the story is they don't care what the freak he says.
Even if yields rise, markets are going to focus on the earnings effect. So I'm just going to say it could go either way. I mean, it could be better, it could be good.
When you hear Jamie Dimon talk about there will be cracks in the bond market, do you just brush that off as that, I would expect someone in Jamie's position to be talking about the risks that are in the system? Or do you sit back and say, well, maybe that first little scream from the bond market was before there's a full-on tantrum, which wouldn't be good for equities in any way?
Well, JP Morgan has a dashboard to the U.S. economy because they see consumer credit.
Sure.
They see it real time. We know consumer credit delinquencies are rising and auto loan delinquencies are rising. But is that going to spill over into the broader credit market to create a credit event? The one market we watch is high yield. High yield spreads have actually managed to hold on to most of the rally gains, and they've retraced 70% of the widening. That's a market that says the economy actually is starting to strengthen.
So you don't put that much cred into bigger worries about the bond market having an issue anytime soon. And even for accuracy's sake, I mean, it's not like he said we're going to have this issue tomorrow. I don't know if it's 6 weeks, 6 months, 6 years. I'm paraphrasing, but that's generally what he said.
Yeah, I mean, I think Jamie's flagging that there are parts of the economy that are weak, including housing. I mean, housing is deteriorating very quickly, but that's also going to deliver a pretty big deflationary pulse. That was 75% of the rise in inflation since 2019 is housing and auto services. So if housing is turning down on price because there's supply, I would argue that's a structural decline in inflation. The Fed would actually have to be quite dovish in the next 12 months. That's bullish.
How many times does the Fed hike between now and the end of the year?
I think you mean cut.
I meant cut. Sorry.
Okay.
I hope that wasn't a Freudian slip. Cut.
Yes.
Again, this is something I definitely agree with Trump on, that the Fed needs to be cutting 100%. Like, there's no reason, zero reason why they should not be cutting. Zero. At the end of the day, the Fed funds rate right now is, what is it? Somewhere around 4.5% roughly, right? CPI is in the twos, and it's going to be in the twos, and it's going to remain in the twos. You have to cut Fed funds rate into the twos. No debate. You're way too restrictive right now. And I think the Fed's allowing an easy get out of jail free card for Trump if the economy does go south, because he's going to say it's the Fed. They kept rates way too high for way too long. This is their fault. They're the ones that put us into. And he would have a strong argument to be made, because you can't have your Fed funds rate up here when your CPI is way dramatically lower. I mean, we're talking 50% lower than where the Fed funds rate is right now. And there's no inflation worries. You say, oh, tariff, blah, blah. We're seeing no data that's saying like, oh yeah, for sure, this is causing everything to go up massively in price. Nope, not seeing it, right? And also, you shouldn't be, the Fed's supposed to always be data dependent. If you want to try to predict, what's going to happen to price because this tariff might be blah, blah, blah in 6 months from now or 12 months from now, now you're in an opinion game, not a data game. And the Fed's supposed to be data dependent. The data says lower rates. They should be lowering rates right now. They should lower rates today. Factually. Economics 101, they should be lowering rates today. But they're not. And I don't know, like if they have their next meeting and they still lower rates, I think it's a really bad look. It means they're way behind. They're already way behind the curve. It's just a question of how far behind the curve do they want to go. And then we've already seen this game. They already did it once. They already did it back in 2021. They kept rates way too low for way too long. When it was obvious we already have massive inflation problems, but they looked the other way. Now it's obvious we don't have inflation problems and they got rates way too high. Come on, man.
They may not do any cuts between now and the end of the year. But
that'd be fine?
Yeah, I think the stock market, now that we're in June, is starting to look at 2026. And I think the Fed's going to be, they're in a position to do cuts next year. That's what's going to be bullish for equity.
Lastly, still ride this tech run?
Yes, I think the Mag 7 were the first to peak, the first to bottom. They were the washed out stocks that didn't make new lows in April. So we like the Mag 7, but we also like this financials, industrials, and small caps for the second half.
Tom, why do you keep doing this to yourself? Last year, you said you like small caps for the second half. And you said they were going to go up 50% in the second half or something like that, didn't you?
Yeah.
But why do you keep doing this to yourself?
Well, the small caps have gotten hurt because the Fed has been on hold. It's been a hawkish pause, but I don't think the Fed's next move is to start raising rates. So, yeah, I know it's been not a great call, but I think small caps are still a second half story.
All right. We'll leave it there.
Thank you.
We'll keep checking back with Tom Lee.
Yeah, in regards to small caps, here's what I'll say about small caps, okay? They're due. They're due. Small caps are significantly lower today than they were like 4 years ago. And when I say small caps, I'm talking about the Russell 2000. They're due. It's just a question of like, it's like being at a roulette wheel. And, I live in Vegas, so, we can always give it to like a gambling term. But so you're at a roulette wheel and you see, in the last 8 spins, 7 times it came up red, 1 time it came up green, right? Now, there's still the same odds as always. That's, would come up black versus red versus green, right? The odds never technically change. But at the end of the day, you look at that and you say, 7 times it came up red out of the last 8, 1 time green. Black is so due. It is so freaking due. It's got to come up, right? And you put $100 out there. Come on, baby, right? That's what we're looking at with small caps. You're looking at these small caps, and it's like, they're so freaking due. They're lower than they were, 4+ years ago, and all the inflation that's happened, everything like that. They are due to go on a big run. It's just a prediction of like, are we in it now? Is it still 3 months out, 6 months out, 9 months out, 12 months out, 2 years out, right? All we know is it's due. And it's coming, baby. And so that's what I'll say about small caps. And, if small caps have started a big run, it's very, very bullish for stocks like Cake. It's very, very bullish for stocks like Fubo, stocks like Honest. Any of those like smaller cap type stocks, definitely very bullish for even companies like Revolve, RVLV, some of those sorts of stocks I own, right? Because obviously I own big dog companies like Palantir and like Google and Adobe and Amazon, those sorts of companies, right? But I have these small cap stocks that are actually performing very tremendous, even though we still haven't really gone on that beast bull run for small caps. If that happens, a lot of those stocks you'll see skyrocket.